Great, thanks, Bethany. Appreciate it. My name is Chris Gallo. I am the State and Local Tax Director at Bergen KDV, working closely with Larry and Vertex here. Happy to join the conversation, being the second part of our presentation here. My experience stems from Washington, D.C., working closely on Capitol Hill with between state and local tax, states and federal tax. Joined Bergen KDV 5 years ago to stand up their state and local tax team, and have been working closely expanding our knowledge base as well as the clients as well. So thank you very much.
Hello, everyone. My name is Larry Mellon. I'm a tax director in the Vertex Chief Tax Office. I've been involved in tax for a little over 30 years. The bulk of that time has been in managing and directing sales tax, use tax, all indirect tax compliance, both in heavy manufacturing, retail area. I've been with Vertex for 17 years now. And thank you for Bergen for having us on. Appreciate that. Can we have the next slide? So I just want to go over some agenda items, and I'll go through some of the things I want to cover, and then I'll be turning it to Chris. But some of the areas that we had discussed at the end of the last session that we had is that we pretty much advised that we were going to come back and talk about some compliance triggers, some areas for you to look at. Just kind of have a discussion on some of the things that we see out there that you may want to look at that are issues that you may want to, or you're already aware of, but we could certainly see about evaluating some of those. We're also going to talk some more about the impact of increasing audits and how they're enforcing that. We are seeing that, so we'll talk a little bit about that. And then we'll just talk about some confidence we have with our compliance, like how do you feel in the decision making that you had? How are you feeling confident at the product and services that you're putting out and that they're accurately taxed? So we'll spend a little time on that. Next slide. There we go. One more. So let's talk about some compliance triggers. So we know that, just on the sales tax side that, jurisdictions certainly have their changes that they often are looking at for the products and services that are being sold by you in multiple jurisdictions from the state level all the way down to a district level. So these changes often, are overlooked by you until you're sitting in front of an auditor. An auditor, of course, is trying to look at this information and determine its taxability. So one thing to kind of look at is, you as a customer, you as a supplier to someone should be evaluating the tax decision that you make on products and services. You should be looking at that to see if changes are needed on how you are taxing those things. We know that decisions are made that you're selling a product or service and you've determined its taxability and how it will be taxed. Then often what happens is that the decision of how that product or service is changed or how a taxing jurisdiction changes its taxability on that. So you need to be, one of the triggers is for you to make sure that you're going back evaluating how you've taxed things to ensure that it does not become a major compliance trigger. So often triggers, they start, at an audit. It's when an audit's due, they're conducting it. That's a lot of times when you find those triggers. But, often audits, they do start out of the blue. They get your number or they want to contact you. But most times when we see triggers, it's because of something that you have done. Are you issuing an incorrect invoice to your customer, and that customer is now under audit? And when that customer is under audit, it's being pulled out because either it has the incorrect rate that's on there or just that the taxation is wrong on that invoice, and it's a trigger for the customer, which ultimately becomes a trigger for you that you have to go back and look to ensure that you're making sure that invoice is correct. Often what ends up happening is that once that becomes a trigger and you're aware of that, you have to make that change. Hopefully, if a customer of yours is under audit and identifies this, they're certainly going to be reaching back to you to say, hey, you've given me an incorrect invoice. That right there is a major trigger that you have an opportunity to make that change right? From that point going forward on taxability, also gives you an opportunity to look at what is your exposure before that, book a reserve, make sure you've covered for that for the future. Often what happens, and most people can't, maybe don't understand or don't admit to that, is incorrect tax returns are filed. Often you're filing a tax return, you may be doing it manually, you may have the programming that you put in yourself, may be putting sales or discounts or in different fields or incorrect fields, and then an auditor is looking at that, or the taxing jurisdiction is looking at that, which then creates an audit risk for you, because they are going back and they are looking at it and seeing that the return, is done incorrectly. Often, sometimes with that too, is just if you're a business that's often getting notices that's coming in from a jurisdiction, something's wrong, they're reporting something back, you did this was late, something was filed. They kind of look at that and say, okay, maybe their controls and stuff are not in place accurately. So something like that could also be a trigger that, based, if you're starting to see every time I submit this quarterly return, monthly return, every so often I'm getting a notice back, well, they're getting a notice, they're tracking those notices, and that too could become a trigger for you.
Yeah, adding into this, Larry, too, another trigger around the audit, but also voluntary disclosure. So many businesses, we're going to talk about this a little bit, are cleaning up any compliance issues that they've had. I'm going to explain how to do that. But our firm has hundreds of voluntary disclosures in at a time. And what that is the business is coming clean to the state and saying, hey, we may have made these mistakes prior. We need to clean it up. And through that, there's a lot of disclosure of the mistakes that were made. And so if your clients or vendors or whomever may be reaching out to you to say, hey, did you pay use tax on this? Because I didn't charge you sales tax.
Right.
It's not a good answer to say, I don't know, and then move on. Because what will happen is then the business that just contacted you will divulge to the state they didn't collect sales tax from you, and you could not prove that you paid use tax. Right. Instant audit, chance of audit there, and it's happening all over the place. Like I said, hundreds of those are going through our office every year.
Right, great, thank you. So let's talk a little about some of the impacts of the audits and a little bit on enforcement. So we know that jurisdictional audits are returning to normal as much as they can. We are finding that these audits are increasing. We do know that more businesses are returning to normal and in the workplace than auditors are. We know that states have a little bit more, I guess, more criteria to return, so they're not getting there as quick. Plus, as those auditors are returning, they have a backlog of audits that they were currently working on. So in some jurisdictions, we are seeing an increase from jurisdictions reaching out for audits. Some of them, they are not. With that, many of these auditors are trying to do 100% remote audits because everything has been done electronically, and they're seeing that you've been able to file and do compliance. We are seeing a mix of that because we know that there are some businesses out there that still want to see an auditor on site and do not want documentation leaving, or don't trust that they're putting things out on a secured site to keep their information, and how is that information used. So we certainly can't change how businesses look at how they want to work with an auditor, but we are seeing that they are trying to come back. With them trying to come back, they are engaging and are reaching out to start audits. But what we are hearing from people is that they're beginning to start these audits. They're sitting down, going over what they want to do, and then the audit becomes stalled, right? So they've came in, they've met with you, they're looking at these things, and then they turn around and they come back and it's like, okay, well, we don't have ready for you. We don't have this ready for you. And you're trying to provide them documentation for the audit. And often they're kind of bogged down because they've blanketed an area with audits and they've started these audits. Now they're coming back to you to sign these waivers to extend it because they've gone kind of silent on these. So And that becomes an issue because then you're consistently asked to provide more information. Um, I would only suggest that, in any audit or for any tax professional is to keep that audit moving. And it is a two-way street. They could be asking for information and you may not have the bandwidth to provide that information. But I recommend anyone just to keep that audit moving as much as they possibly can. Don't let it go silent, because the taxing jurisdiction has the ability to drag it out and want waivers. But I think it's very clear that you state in the beginning, where you want to be during this audit after a period of time to try to move that along, especially if it's an audit that you've already been involved with before. They're coming back for their 3 or 4 years. They're coming to look at it again. You know what to expect. They should be seeing things and hopefully things run smoothly. Um, Another thing that some of these impacts they have is, you need to do your due diligence prior to starting the audit. A lot of times people get a notice and the audit gets out, they get a notice for an audit, they contact them the day they get it and say, let's start this audit. I'm not saying do not reach out or do not engage them, but I'm saying that is your perfect opportunity to say, here's the period that they're looking for. Let me go back and look at my sales transaction. Let me go back at my use tax. Has my cut calculated this correctly so that I have paid tax where applicable? So doing some of that stuff will kind of, help with that. They're often, looking at some of the technologies that are used. We're working to streamline these, but to try to make it easier when working with the auditors. But certainly spend that time to look at those waivers and understand that enforcement. What they're doing with some of that enforcement is, they are going to be establishing the fact that they're going to be charging you interest and penalty if it's not compliant. So if they are on and they want that stuff, make sure that you're ready with the bandwidth of the people you have to be able to comply with what they're asking for. Ultimately, they're going to enforce to get that moving along sooner than later, but you're going to want to make sure that you're ready to go with that audit immediately to get it done timely so that you don't have to deal with any enforcement, interest and penalties and those type things. The next slide. So I want to talk a little bit on the confidence within your business and how your compliance is. So, you have to know accurately what you're assessing for the sales and purchases that you're making. Often we find out that when you're selling a product, you have an understanding of what that product or service is. Whether you set some type of formal process that works within your company, that every time they're going to sell something new, you should have some type of understanding of what that product or service is so that you can accurately assess tax based on what that is. And one reason for that is that if an auditor does come in and they do want to look at that information, they're going to want you to provide some information on, well, actually, what is that you're selling? What is it used for? You're going to go back to those same people to say, what is this being used for? Or you've gained that knowledge from talking with them so you can understand what it is and how it's being used to make sure you accurately are taxing that. You also have to make sure with that too is that, you're accurately reporting into those taxing jurisdictions. You have to make sure that have you captured? Are you in? Are you filing correctly? We know that for 2021 that there were 197 new local taxing jurisdictions established in North America, right? So of 197 spread throughout the 50 states of the US, you could be now selling in one of those areas that now has set up a new tax. You have to understand where are new taxes being assessed and collected because you could have some exposures. So being confident is understanding where you're at with all these. I think it's also very important and vital, planning and understanding every aspect of what you have to do and communicating with your customers, right? Especially on the use tax side. So on the use tax side, you as a tax professional certainly have, strong knowledge of what you're selling as we just spoke of. But looking at the purchases that you're making, when an auditor walks into a door to do an audit, and you're providing them here is everything for my sales. You can look at everything you want. You have confidence that that's right. And you're going to look at that. they're going to see an invoice that has sales tax on it. They're probably not going to bother looking at it because you've already taken care of the tax. They're going to spend a lot of time looking at your exempt or non-taxable transactions. Especially they're going to look on the use tax side. There's so many invoices that you process in operating the business that you don't know if a particular product service of what you're purchasing is taxable. You're geared potentially for most point to understand the taxability of what you're selling, and that's where you've been working. So understanding that use tax side is very important so that you know what you need to do to ensure taxability and whether you're assessing appropriate use tax on the purchases that you're making. And that's the area that an auditor is going to look at right away. That and capital expenditures. Even though we're seeing a decrease in capital expenditures because people aren't in the office, we do see some issues with the amount of capital purchases of equipment that people are using as they work from home. So make sure you're aware of that and make sure you have proper taxability if you're in one state or one county or one jurisdiction on where you receive the computer as an example, and then where it's being used. Make sure that you've taken care of that taxability. Also, everything that with exemptions for manufacturing, R&D, that's another area. You want to make sure you're clear and you understand that everything fits into that guideline. If you're taking and you're listing as an exempt transaction for manufacturing or using it to develop what you're doing, make sure you're clear and you understand that only that piece that's being used there. If it's a bundled invoice or it has many detailed things, make sure you're breaking that out and you have accurate documentation so that you can prove that. All these things will kind of help you with some confidence to make sure that if you follow some of these things, when an auditor does come in or when you're looking at higher ups and you're looking at this stuff, you feel comfortable in the products and services and how you're taxing both sales and purchases, right? So at that point, I think that was our last slide I had. I'll turn it over to Chris.
Thanks, Larry. I would strongly encourage anybody when you're determining tax and or use tax, don't assume anything. And if you did your study last year, high likelihood that it's changed. It could change for the better that you don't have to collect tax anymore. It could change for the worse that it's become taxable. Generally, it's becoming taxable. We talked about that last time about all of the new tax codes that are being created. So don't assume because it's a service or whatever it is that you're providing, it's exempt or non-taxable. So picking up from where I left off last time, how to assess what you're doing, right? So a nexus study, that's the first part that we get into is gross sales by states. And this is a little bit of a review, excuse me, but what we've got here is your company, your business, states in the left-hand column. Here's the threshold. We're running your gross sales pursuant to the state requirements. And you can see here, we would actually start with 2017. This is 18, 19. This is the real life spreadsheet that we're using as a matrix. The exposure areas, obviously the names have been eliminated, but what we would determine is where is the business creating exposure. And moving on, what you'll find is throughout the years, we'll see a total sales subject to tax. So that's total gross sales subject to tax. We determine the current registrations, where you may be registered, where you may be filing tax. We enter in exemptions, spits out exposure, whether it's physical or economic. There's a determining factor there. Again, we kind of went over this the last time. In that, we then run it through the taxability study, next slide, and the total liability calculations here. So what you're selling taxable, right? In this case, it's service or parts or maintenance or whatever it may be. What's the taxability? The final calculation here, as the spreadsheet's broken up, is the total state rate and then local rates. And then that puts together estimated exposure, local exposure, total state and local, and it essentially spits out a number. Your business, pursuant to the review, owes X number of dollars, and many times it's in the millions. Even if it's in the thousands, it's still you owe. in whatever states that we've determined. So that's the exposure analysis that we talked about last time. What to do, right? So let's just pick a number. You got $1 million of exposure over the past 3 or 4 years, whatever it may be, in X number of states. What do you do about that? The VDA is a voluntary disclosure. Okay, and what you're doing there is Bergen on your behalf goes to the state and says, hey, we've got a client. We have some compliance issues. We have been calculating at an incorrect rate. We haven't been calculating at all. We've noticed some errors and we'd like to come clean, make a payment to you so we can get up to speed, become compliant. They call it a letter of good standing. A lot of times you'll see this from P&E, right? Private equity's coming in, your business is gonna be sold. Can't do that without a letter of good standing. So you wanna become in good standing with the state. The voluntary disclosure, again, is us going to the state and saying, we'd like to come clean. What does that look like though, right? A business can take this on their own. It's hard to be anonymous when you're doing it on your own. A firm would be anonymous for you. But this is an example of what you're going through. So we've got, the states, the forms, the how-to. This is, you would be given a number once you make the application. There's a lot of different things that go into this. What is showing here to the right is the general look back period, and each state is different. So I've highlighted this. You can see, I think it's this applies here, yeah, Texas. So 12/101, 12/1/2017 through 1/31/22. Another one is you must request the proposed dates that you're voluntarily disclosing. The other one is a mandatory 3 years proposed, maximum 5 years. There's different parameters in every voluntary disclosure. So you really need to have an understanding of what this is going to look like from start to finish. Next slide, please. As you're going through this before you really even get into it. It's kind of like an audit, but you're going to do it yourself. When you're voluntarily disclosing to the state, they're a lot more lenient. They'll ask you for the information many times and kind of take your word for it, if you will. They'll ask for proof, and it varies by states. Some are just like, all right, we'll take your word for it. Others are going to want to see invoices. They're going to want to see returns filed if you've had them. They're going to want to see amended returns in other states if you collected, if accidentally filed in the other state. A lot of times they'll ask for work papers, to see what it is that you are doing or not doing to be able to, remove any type of, unintended malice. More examples here. So we've got, whether or not the VDA is approved or denied. We keep track of obviously the deadline to submit. VDAs are going to need powers of attorney, unless you're like the actual owner of the business taking on the voluntary disclosure on your own. You'll have to have a power of attorney. Were they submitted? Is it registration? Has it been completed? One term pursuant to all voluntary disclosures is you're going to have to register and move forward, again, in compliance in that state. And then we're keeping any kind of special notes or questions.
Hey, Chris, just a note real quick on that previous slide. Just, as you're going through VDA, a lot of people, look at VDA like it's, I've discovered something and now I have to, expose that area that's out there. A VDA is something, as Chris was saying, something very simple to put to, not to build, but to file, to be able to recognize when you've had an issue, versus there's many people who understand they have exposure and let it go. It's only going to continue to get larger and things will change. So a VDA is definitely something, as Chris said, a jurisdiction's happy to work with your VDA because you're stepping up with something. They're recognizing that, as much as you may have to have funds set aside to pay for that, usually interest, penalty, stuff like that is wiped out. because you're setting this up. If you let something go and don't do the VDA and then it does get caught under audit, then you have those 3-4 years of your audit plan. Now you are paying that interest and penalty. And now the powers that be are hearing about it under audit versus you doing some due diligence ahead of time and recognizing it. So as much as they can be a pain for recognizing and having to step up and say this is an issue, they're definitely a great tool to be used.
Yeah, good point. The waiver of penalty and interest is always extremely helpful. So what's next, right? When we're advising businesses, we found the compliance, said, okay, here's the issues, here's what you owe. We've gone through the voluntary disclosure process. You've come clean with the states. You've got the registrations that are going on, right? You're in good standing. What's next? And this can be, you don't have to have a voluntary disclosure. You could be a new business or entering another state, or you're upscaling your tax collection sophistication, or you're outsourcing it. So what does that look like? And these are real world examples of exactly what it looks like when working with us at Bergen KDV. We put together a plan here. We've obviously got engagement letters. We're looking at, the onboarding software setup, registrations, product discussion. We're really going through all of the steps that I've already showed you and putting it into, again, a production plan. If you're taking this on your own, next slide, please. You're going to need all of your states that you intend to register in. Obviously, they're going to give you a registration. You need to do that. You have a tax ID number, the date that you're registering, filing frequencies, when do these things become effective, and keeping track of this is half the battle. Moving forward, state the registration notes. So after, I'll give you a little bit of a history here. In 2000, so let's see, June 21st, 2018 is when Wayfair was gifted to all of us. And the Supreme Court said states could compel businesses to collect sales tax on the behalf of the state, even though from an economic perspective, no longer physical. And Bergen KDV was one of the few practices that was kind of ready for this. But even being ready to file returns, we've learned a lot in the 4 short years that this has been in place. So this is all of the notes, right, that we're keeping on how the heck to register in each state or local jurisdiction. What are going to be some of the technicalities? You can see here how to do that. In individual states, there are some registration fees, others don't have them. As a business or a practice, you are going to absolutely want to make sure that you have your practice, your processes and procedures down. So anybody can pick that up, look into Alabama, click on it, and then start walking through what the process is. And so, this is just a snapshot of what we've got, but you can see in 4 quick states the difference between, registering fees. After 2 to 3 days, browse. This is reality. After 2 or 3 days, browse out to the California Department login screen under registration section bottom. They're not going to contact you. The state's not going to follow up with you. You've got to have reminders on how to register, when to register, when to follow up, and what to do. And if you miss any of these dates or you miss any of these notifications online, it'll expire and you'll have to start over again. So moving forward, this is our Department of Revenue resources. So you can see obviously the state, you've got the online filing URL, the tax types that they're going to ask you to file. They're not all called sales tax. Some is a retailer's use, some require a sales and use, some don't. Some call it a general excise. There's the tax form. Going into this and clicking first time on Hawaii, how would you have any idea that it's the G45 and the G49 and that they call it a general excise, not a sales? There's a whole bunch of different technicalities here that you would have no idea, just going in blind. California's a good example moving forward. I'm going to show you a few slides here of just a California registration. And when we're going through and registering for our clients, one of the first questions is, why do you need so much information? Why do you need our social security number? Why do you need a driver's license? Why do you need all of these things? It's because it's required. And it doesn't matter who's doing it. it's a requirement of most states. You can see here, again, California, a copy of the officer's driver's license. So if you're the business officer owner of the business, you're on the record. You're going to be on the hook for unpaid or unfiled sales tax. That never goes away. This is how they get you. This will be uploaded with the application, the name and the address, and the description of the products with the supplier. This is real life. So then you go through the above link, take you to the home page, click here and register. Looks pretty elementary, but if you don't have this in front of you, it's a stumbling block at every click. And the thing is, these things time out on you too. So it's almost like a game. You'd think that somebody's sitting there watching you to see if you can get done in the time that they've allowed. And if you don't know what you're doing or have the right amount of information on hand, you don't have the driver's license of the officer, there's no way you're going to get this done in time. Just moving forward here with more of the how-tos on a state registration. This is one state registration in California. You can see we've got, when you get to this page, you're going to need an FEIN. You're going to need this, once you provide that, the California Secretary of State will change the non-California entity number. You'll need that to enter instead of the FEIN. So there's lots of processes that go through here. California is one of 50 states, right? 45 that have a sales tax, and the other 5 have some form of other tax. So a registration typically is not just a sales tax registration. It's not just a use tax registration, right? You've got Secretary of State registration. You may need a franchise tax or a business tax or a registered agent. All of these different things may be a requirement just to becoming registered in the state from an economic perspective. You're okay. Oh yeah. All right, where are you at here? I'm just following along. All right, perfect. So once you've gotten registered in the states, it's how do you collect sales tax? So you've noticed, all right, well, we made a mistake before. Maybe it was just a 0.5% somewhere, but it's a state and local jurisdictional issue that you found nationwide, and your calculation tool, the ERP that you purchased, say calculated sales tax, actually didn't do it right. It happens all the time. So that's why, as a firm, we really rely on the sophistication of Vertex, that people like Larry are behind the scenes making sure that the tax codes are right, the tax rates are right. When they change instantly, and this is done every single month. As a business, you have to determine what are next steps. How are you going to calculate? I'm going to go through a couple of viable options that we use. So right here, the first one is a rate file. And a rate file is simply, you can see the state, right? The destination county, where it is, the zip, and it's key here that sales tax is calculated, or use tax is calculated by an auditor on your behalf, to the zip code. And it's not just the zip, but it's the zip +4. So it's considered at the rooftop level. And where I'm sitting right here could be different than the building across the street from a zip code, from a zip +4 and a taxability standpoint. Could be a 0.5%, could be a full percent difference. I like to use the example of Beverly Hills 90210 for those of you who were in college at the same time, and we were all watching is it a sitcom or the series, whatever, it doesn't matter, right? In Beverly Hills 90210, it's a zip code, but there's like something like 11 different taxing jurisdictions just within that zip code, and it's calculated something to the effect of 11 different percentages from one end of, I think it's Rodeo, to the other. And that's a true story. So you need to really understand where your business is and be calculating at the actual rooftop level is what they call it. So
yeah,
this
Chris, that next column, the TAID, is the tax area ID, and that's kind of like a longitude, latitude mapping of the whole world that kind of looks to a specific pinpoint that determines the taxability, as you said, on one side of the street and how it's different on the other side of the street.
Yeah, awesome. Yeah, thank you for that. And so what you can do here is you're determining how you're going to calculate tax. You really need to think about it. It starts with technology. Can your ERP or accounting system calculate tax? Some of them have it built in, right? Some of them are already integrated, but most of them are not. So you need an outside connection, or you need to upload. So a rate file, this is a CSV file. It's very manual. It's obviously printed out. We would send it to you, Vertex would send it to you, you buy it, and you upload it into your system. Generally, if it's an on-premise system that can't connect to something via, an open API or web source, you can upload with a rate file. That rate file is then programmed, or your ERP and accounting system is programmed by your technician to anytime it sees you're making and creating an invoice, it makes a call at the time of the invoice out to the TAID based on the zip to then grab the combined state, county, city, other, right? Make that calculation based on an auto call and then apply to your invoice. It's pretty manual, but it's an automated way of being manual. You can see right here, this is just simply Georgia, mostly, what do we have, 4 counties in Georgia. This is a massive document. It's a pretty big upload when you do that, if you do it monthly. Most businesses will do it quarterly, but monthly is the recommended, just in case anything changes. So that's one way of doing calculating tax. The other way is the adjustment file. So really, when you calculate tax, if you are not automatically connected to Vertex, you have to then download the tax that is connected. And it doesn't necessarily matter how you've collected or calculated it at this point. When you produce your file, you need a certain set of columns of information, right? And you can see here, it's kind of funny. It's called an adjustment file, but it doesn't actually adjust anything. It's a matter of informing the technology that we're using, which is Vertex again, on what you intend to file. So where did you collect it, right? So what's the invoice number? This is what you would pull. The date the invoice was collected. More information, zip code, special zip code, a product class. So what Larry was talking about, we'll touch on here in a little bit too, is what is it that you're selling and how are you defining it in those states, right? So if you're selling chairs, but you're calling them calculators, I just got them right here, right? Those both may be TPP and it might actually work in the state. But if it's food categorized something different, that now you're off in your mapping, your calculation, your taxability is going to be all wrong. So you have to understand what your class and your codes are, the price, and then the total tax amount. If you have somebody doing this for you, we obviously build this out for you, Vertex will build this out for you, and then you apply it to the technology which populates returns and files. It's still manual, but a little bit less manual and a little bit more connected. The next way of calculating tax is getting connected. This is the end game. This is where you want to be. So you've got an ERP system. I'll pick one, NetSuite. NetSuite has an open API. There's lots of them. If it has an open API, you can go to Vertex and you can buy the calculation software. You can get it through us as well. And what we would do is then make the connection. So I liken it to a plug on an extension cord and a socket in the wall, and that's your API. You make that connection, you're now connected, okay? That allows your business to have up to the second accurate tax calculation that is applied directly to your invoices at the time, okay? Moving forward, once you're connected, you take all of the registration information. And you don't have to be connected to do this. We've also got ways of taking the adjustment file information and using this type of software as well. But you've got your states that you're registered in, okay? And if you look here, right, you either turn on the state or you turn off the state. And you're simply telling Vertex, hey, we intend to file in this state. You turn on Alabama, it's effective when, which return. We've got one return. We have 0 locations. This is fairly elementary here, but if you look down, Colorado is a good example. Pay attention to Colorado. 2 returns, this is one business. This is a real life snapshot. One business has to file 2 returns in 270 different branch IDs. Right, Larry? In Colorado, I think there's something to the effect of 640, right? 640?
Yes. Yep. Around there. Yep.
All right. It's still relevant. Yeah. So 640. So out of those 640 individual registrations, which is a branch ID, we've identified 270 of them that this applicable business is filing into. And so you've got to tell your filing technology where you intend to file, and then you're uploading all of the information that you have registered. Moving forward, once you've got registrations done, you have to map your products, okay? So when you're connected, you're telling the technology here, you're telling Vertex that we are selling 100% vegetable juice here, right? And it's drop downs, it's clicks. So we've got general, that's all of the Vertex codes. You get into TPP, that means it's a physical product. Now we've got food and beverage. It's for home or non-immediate consumption. It is 100% fruit juice or 100% vegetable juice in this particular case. Every single one of these drop downs potentially changes the taxability of the product that you're selling. So that's what I mean, like, let's not go assuming anything here. You need to make sure that you have a taxability study done by a professional that breaks it down this far on every single product that you've got. Now, the caveat to that is you don't have to always map crayons. Is a good example. You wouldn't map a red crayon, a blue crayon, an orange crayon, and a yellow crayon. You would just map crayons, right? You probably actually wouldn't even do crayons. You would probably stop at TPP goods here. I'm getting a little more technical, but you can see the difference is how much technicality do you have to apply to your product by SKU. When you do that by SKU and or class, Larry's team's on the back end making sure that the tax all applies and that you're applying the tax then correctly to your invoice.
Yeah. So a lot of that, it's based on you having the knowledge of, as I said earlier, you having the knowledge of knowing what the products and services are that you are, delivering to your customer to be able to do this accurate mapping.
Yeah, good point, Larry, because it's safe to say you've got a really good understanding of what you're selling, but you don't know how it applies from a tax rate.
Right.
And this is a good example of how technology, and advisory come together. Because Larry's team's not going to tell you what buttons you should click. They might be able to give you some advice here, and here's a taxability study, you fill it out, but the responsibility is not going to lay on Vertex to tell you, whether or not these things are taxable.
Yep. I use this quick analogy, Chris, a Kit Kat bar. We always talk about a Kit Kat bar. People think Kit Kat bar is a candy bar. It's actually a baked good because it's a wafer covered in chocolate. So it has different taxability than a Hershey bar that's 100% chocolate. So just some of those complexities on how taxing jurisdictions in some states that has a different taxation because it's baked goods versus candy. So those things are all built in there. So the people who make a Kit Kat have to understand that it's a baked good, not a candy bar when they do their tax mapping. So that type of analogy.
It's a great analogy too, because now I'm looking for a Kit Kat bar. So good stuff. When you're getting into the mapping here, you then have to configure your customer. Okay. So what you want to focus on here is, I don't know what column it is, but it's the taxable result based on the customer and the certificate. This is where you enter an exemption certificate, right? So if the customer is a manufacturer and you're selling, it doesn't matter, something that would be exempt to manufacturers only, they give you a certificate and then you have to upload that certificate, which then triggers when this client of yours, or of ours, anyways, is buying something, or if it's you calculating the tax, right, and you've got a vendor that's buying something that is exempt, it's applicable by the exemption certificate, then triggering the technology to calculate the gross sale non-taxable. okay? Because when you file your sales tax return, you have to calculate all gross sales, but here it's going to trigger an exemption collecting zero sales tax. So you've got the gross sales, but you're just not actually collecting the tax, so you're filing the right return. So this is an example of how you would upload certificates pursuant to each of your clients. Moving forward, we're looking at here. So now you've got the whole thing built out, and what happens when the technology starts working for you? You can see the returns here on the left in the states. You got Alabama and Arkansas, Arizona, right? What you're looking at here is, this is a screenshot of a portal. You can look at your reconciliation reports. We'll talk about that. Credit reports look like, if there's any unassigned data, so potentially something came through to the technology that it didn't understand. Comes up in a report that says it's unassigned data, right? Maybe it's a zip code that doesn't actually exist, or it just couldn't be applied. That'll be spit out so you can do something with it. And then you can actually download your returns. You don't have to be connected to do this. This is actually what we look at every single day when we're filing returns. So having technology is a way to store all of these returns for you. You can just see them, provide them to an auditor should they ask. Moving forward, once you've finished your registration, your taxability, all the good stuff, you're up and you're running. This is what you're looking at. Generally, you could do it every day, but that might be a bit much at the end of the month. Here you can see we've got 48 returns across all of the blue states that are being filed. California in this particular month for this particular client has $164,000 in sales tax over 100. What is that? 12,162 total state tax. So you've got snapshots, and then you can click on any one of these states. It pulls up the information. You have all the historical in front of you as well. This is where you want to get to as a state. We like to call it audit proof at this point in time. Once you've gotten to here, it's all right in front of you. You've got the technology working for you. You've got the exemption certificates working for you. I like to think Bergen's already built this and done it all for you. So if your head's spinning, we got it. It's taken care of. We're using Larry and the team to provide all the tax technical. We're putting together the compliance and the advisory for you. What do you receive as a client? Let's just assume that your eyes are crossed here, right? You say, take care of it. Bergen's done everything that I just explained. You're provided at the end of, well, next week, the very beginning of the first week of the month, a reconciliation report. And what you can see here is the state, the return, the filing frequency, the total tax balance. What it does is it spits out the net payment, okay? And what you're looking for here is, did you collect that much tax, right? Some of our clients look at it differently. It's just gross amount. Yep, gross amount. My bank says I got $4,398 in the old sales tax accrual account. Good to go. I assume the technology did it right. Others can look at it by state, and they know exactly how much they've collected by state and what they would intend to file by state. What you also see here is there are some discounts that states will apply when you do things correctly instead of tax and penalty. You get prepayment discounts, and you are actually able to keep that as the business based on having collected the tax and then the state providing you a discount. They're not huge amounts, but you get them. Once you as the client or you are looking at this, you say, yep, my reconciliation report looks good, it's approved, all of the returns are filed. The returns are filed and the payments are made to each individual state. All of that record is kept electronically. You as a business are then provided a funding report. Okay, and on the funding report, you would want to reconcile that with the reconciliation report saying, okay, we intended to file $4,398.01, and we did. So we intended to file it in these states. We did file it in these states. On the rare occasion that something didn't happen right, maybe a login expired, maybe who knows why, the return couldn't be filed. That's okay because you're seeing it here on a funding report. Okay, if you don't see funding happen, then you want to look into and find out why. Could be maybe the link broke. It could be any number of reasons. When that happens, because the process in the Vertex world, the professional world, is we file by the 9th is our closing day to get the information to technology that starts then actually filing the returns electronically up until generally 17th, 18th or so. Most states require returns to be filed by the 20th. So when you get a funding report and you see a gap and you find out that there was a reason that it couldn't be filed, you still have a couple of days to manually go into that state portal based on all the information slides ago that I showed you for the client, right? You click the client, you click the state, the client list, you've got all the return information, and then you file manually. That's a fully outsourced program that we offer. So we're taking care of this for you. You're given the funding report, right, for your records. Once all of that is done, and that usually takes, I don't even know what slide it was here, but that's a go live. There's always kinks to work out. Something always breaks the first few times. And that's why you want to have a backup team or a backup plan. You can do it on your own. But you want to have a team of people that understands when something breaks, what's going to happen and what you're going to do so you can remain compliant and limit those notices. Notices are going to happen. They're absolutely going to happen. When you're filing in 48 states, you're going to get a lot of them. It's the goal is to have a quick answer as to what happened, whether the state's even right or not, because many times they auto trigger a response based on something that happened technically and it's wrong. So you never want to jump all over Vertex and say, "What did you didn't do that?" They're like, "Yeah, we did. The state just messed up."
Yeah, I think you have to. I think what's good about that, Chris, too, is that you need to, as you do continue to get notices, whether you a company that gets them often or doesn't get them, is keep track of them. Like, don't just have them in a drawer when they're coming in or put into that state's file. Plot them, track them, so you can track to see, why do I see that I'm getting a notice every quarter on this monthly sale? Well, what am I doing? Maybe I'm doing something wrong. Is it populating incorrect? Am I putting wrong information? My account number's off. Something that's triggering that letter. So just track it so that you can work to correct it, so you can eliminate it.
And most of the time, it's something mundane like that, right? It's like, oh, number was wrong. The state doesn't mind. You fix it, you apply for a waiver, they grant it, you move on. It's when things are done extremely erroneously that they take less, or they take a harsher. So I can see here, this wraps it up here. Are there any questions? I know we went through a lot of this very fast, but you just really saw how the sausage is all made in a variety of different ways and what a really high functioning state and local tax system should look like.
We did have one question come through here. Again, if anyone does want to submit a question while we're live, feel free to use the chat or question function and go to webinar there. The question that we got come through here, rather specific example I'll say here, but I think we can answer this one. We have major sales in Alaska, Montana, and Oregon. However, we are not registered there due to there's no tax collected. Do we still have to register?
You're no tax collected, meaning there's no sales tax in the state? I assume that's what it is.
Right.
Not entirely true. Alaska has local jurisdictional sales tax that you do have to collect. So there's no state tax, but there are local jurisdictional taxes that you do have to register for and collect if you trigger the economic thresholds.
Right, where Montana doesn't have a sales tax, so there's probably not even a sales tax form to submit your sales with zero tax. It wouldn't exist in that location.
Correct. Oregon has a gross receipts tax.
Yep.
So they don't have a sales tax, but they have a tax based on the gross receipts of your sales. I like to put it that way. Because
So this is like doing a due diligence on where you're providing products and services to understand what those exposures are. So if you're saying you have these sales in there and they're not taxed, make sure you're clear in understanding that it's not taxable or that there are not certain tax. We just rattled off a few different ways of gross receipts and no tax. So understanding in that state and local areas, what you're doing for business in those locations. And maybe it's a matter of taking all of your sales and starting across the board and saying, I'm going to look at everything from this dollar amount and above, because I may have exposures, and make sure you're doing everything accurately, and then work your way through the rest of them.
Yeah, it's a good question. I would say, so right there with that quick example, 2 out of 3 of the perceived we don't have an issue, probably you do have an issue.
Right.
Yeah. The severity of them, I can't answer without more details.
Do we have another question?
We did not have any others come through here live, but I did flip to this slide here with the contact info for Chris and Larry there, their emails. If you guys do have any other questions that come up, feel free to reach out. We will also have a short survey that is sent out here following the webinar for you to enter any feedback and or questions there, and that will be passed along to the team as well. But with that, I think we'll wrap it up here, gentlemen. Do you have any other words you'd like to say?
Yeah, the only thing that I would, add to this is if you're sitting here thinking like, what's next? It's gross sales by state, 2017, 18, 19, 20, and 21. I would take most recent 3 years, and we can put together very quickly a high level, what we call very high level nexus study, just identifying, should we look further into any of this?
My only thing would be reverse audit. Take the time, find some people, do a reverse audit as if an auditor came in the door, play the role if you have to, but go through all of your transactions, sales, especially purchases, and see if you have any exposures.
Yeah, we defend and do reverse audits in every single state and jurisdiction.
Great.
Thanks, Larry. Thanks, everybody.
Thank you, everyone.